At this point, every week feels like a month in the markets, especially for traders who are forced to take positions and defend positions amid these massive flows. The market has completely shifted from a inflationary environment, inflation is going to be a problem, to a global recession. We saw our bond yields in the US starting to fall after the October CPI and continued this week and reached a level of 342. Now keep in mind, 10-year bond yields were at a 410 just prior to the CPI report. We're clearly in a market where bad news is good news. If you get good employment numbers, stock markets fall. The market has gotten addicted to low rates. It's as simple as that. That's no secret in the market. But you have to separate global macro dynamics from flows. Now, it's clear that the market shifted to a global recession across the board. Bond yields fell globally, but there's also flows behind that. This week, for instance, we saw massive inflows into the TLT ETF. The TLT ETF is a ETF that goes long the 20-year part of the US Treasury curve. Every day at 4 o'clock, we saw a melt up in bonds or a drop in yields. Now that's common in the equity market where you see a melt up due to large ETF flows, a little less common in the fixed income markets. Nonetheless, every single day heading into 4 o'clock, we saw massive spikes in prices. So as a portfolio manager or trader, you're left to wonder, is this real global sentiment or is it just a flow? I always think it's a combination of both. I think a shift in sentiment spurs the flow, and the flow exacerbates that move. At this point in treasury yields, we're priced for almost no inflation, just global recession. Higher for longer has been interpreted as negative for the global economy. Now, I think the Fed's going to go 50 basis points in December and maintain a 50 basis point path throughout the first quarter of next year. I think 75 is out the window. I think that's too much. In fact, the more the Fed pushes, or if the Fed were to accelerate their path of tightening, you would see bond yields fall, effectively undoing all the tightening that the Fed is doing. Now, it doesn't help that there's fiscal policy out there also counteracting the Fed's move. I mean, the Biden administration just announced that they were going to make Fannie Mae conventional mortgages up to $1 million. So if you think about that rationally, you've got the Fed tightening in order to slow the economy and slow the housing market, but you got the administration trying to stimulate it. The disconnect between fiscal and monetary policy is probably the widest it's ever been. We get asked a lot by clients. We spend a lot of time with clients on the phone asking us where we think rates are going to be a year from now, 18 months from now. And I always tell them it's literally impossible to make that prediction. Sure, you can look at the forward curves and you can look at the first Eurodollar contract versus the fourth Eurodollar contract and make some kind of educated guess. But at the end of the day, it's going to depend on how investors and accounts have positioned themselves for future market moves. I say to them, all you can really do is make sure that you are prepared, whether it be from a liquidity standpoint or anything else, to weather any kind of storm. We see this in the short-dated CD market. Right? There's no shortage of banks and CDs looking to raise liquidity. Now, should they have done that 18 months ago, a year ago? In hindsight, yeah, but that's not how markets usually work, and that's not how investors usually react. If you think that rates are due to fall dramatically over the next year, which many of the large money center banks do think that, JP Morgan came out with a report that they're thinking 10-year notes are going to be around 250 next year, and 2-year notes at around 3%. That's a 135 basis point drop. Now, if they're right, how do investors position themselves? Well, they make sure that everything is in line so that when they need to tap the capital markets, they're ready. Credit unions should start to put in place plans to raise secondary capital. Any rate drop should be met with CD issuance so that banks and credit unions could have the liquidity. When clients ask where I think rates are going to be, I pose the second question: what keeps you up at night? As a trader, I have a philosophy. If I can't sleep at night, then my position is too big, or that I'm in the wrong position. The answer I get back from banks and credit unions is liquidity. Well, if liquidity keeps you up at night, start tapping and issuing now, or wait for any kind of drop and be opportunistic to raise liquidity. If the global banks' prediction on interest rates is correct and we fall dramatically, then what's priced into the front end of the yield curve right now is too much. What's going to start to happen is, I think, investors are going to start parking their cash just in short-dated assets. You get a one-year bill well north of 450, and with a Fed funds terminal rate being predicted around 4.85%, which I think is still too low. I think the Fed will go a little higher than that to really slow the economy. Then there's no reason to extend out the credit curve. There's no reason to extend out the risk curve at this point. Simply park your cash in the front end of the yield curve, roll it so that you're prepared to weather any kind of storm. Is inflation going to be a problem? I can just tell you some anecdotal evidence that I've seen. If you go to the malls right now, there is no shortage of inventory. In fact, a lot of stores are running sales pre-Christmas. When have we seen that before? What they did is, right after COVID, and they experienced those shortages, they started ordering and ordering and ordering a lot. Now they're sitting on inventory in a slowing economy. You're going to see consumer prices fall dramatically, I think, over the coming months. Now, the market's also interpreting disinflationary environment for a deflationary environment. Just because inflation falls from 5% to 4.9% doesn't mean that prices aren't going to stay high. And I think that's a common misconception in the market. Inflation is just a rate of change. So in a lot of ways, the market is overreacting to this drop in inflation. Prices should still remain elevated in a lot of sectors, but the consumer is definitely stretched. We see that in talking to our credit union clients. Why do they need to raise deposits? Well, they need to raise deposits because inflation is sapping their deposits from their customers. Customers are pulling more money out in order to pay for staples like food and energy. I think the most important thing for clients and investors to do right now is to be conservative. Park their cash in high yielding assets in the front end and be prepared to react to the market. If the large money central banks are correct and 10-year notes do fall below 3%, they need to be ready to issue debt. Another thing that's keeping investors up at night and keeping our clients up at night is the prospect of loans for next year. Will there be loan demand? My guess is probably not. Are there going to be asset-backed deals that come to market? Well, right now, triple B ABS is coming in around 1,300 basis points over.